T2 traps are kind of like the framework of like how we look at the market, how we look at structure, how we know when to actively look at a trade. So for starters, one of these traps must be present every time for a full range cycle trade. Now that does not mean that it needs to be present to take a trade, but if you want a full range from internal to external, you want to see some type of trap, T1 or T2. And also with T1, T2, one thing that I'm noticing with most people, the way I do it versus the way they do it, you want to focus with the T1 and T2 on the higher time frames. And I'm not saying it needs to be 4 hour necessarily or the 1 hour necessarily or 30 minute necessarily, but it doesn't need to be the time frame you enter on. So if you're entering on the 1 minute, if you're entering on the 5 minute, I'm not looking for a 1 minute T1. I'm looking for that 15-minute T1 or that 30-minute T1. And then once I get to that 1 minute, or once it gets below my T1 to some type of entry point, that's when I go to the 1 minute, just look for the breakout. You can wait for a T1 again, but just know that you have a higher chance of missing the trade waiting for the T1 twice on the lower time frame. And I think that's the problem that a lot of people tend to have. Um, and also T1, T2 trap is considered liquidity. So before every trade, remember you want to see some liquidity being took. Like you want it to grab something. If it doesn't grab the liquidity, then I mean, not saying it won't work, but it's just not something I would favor personally. So T1 trap, right? I'm gonna explain kind of the second rule to focus more on the higher time frame than the lower time frame. So T1 trap, the way that one goes, the way that one is built is right. You have your breaking structure, running liquidity. Then the first pullback, break structure again. So essentially, it looks like two breaks of structures, right? That first pullback is that T1. T1, cool. So the first pullback is that T1. So what I'm expecting at that point is for this to happen, take out T1, eventually go up. Now, back to the rule number two that I was saying that you want to focus this being on a more higher time frame than the one that you're actually placing the trade on. If this was my 15-minute time frame and I found this T1, let's say I had a point of interest. Where is it at? Boom. So let's say this is my point of interest into the trade here. Yes, you can wait for another T1, let's say on the 1 minute once you get here, but understand that you have a high or a higher probability of missing this trade waiting on that T1 two times rather than just waiting on that breakout. Right now, this was the 1 minute time frame. And I found a T1 right here. Technically, I would want to go to like the 15 second or 30 second to find some type of entry in this area. Um, and that's what I mean by a higher time frame doesn't necessarily mean a number. It's just that your higher time frame is the range that you're trading, right? If you want to trade the 15-minute range, which I personally like the most, 15 and 30, go ahead and do that. But whenever you have that range set out and you have these levels marked up, whenever you get to those levels, that's when you go to the smaller time frame. When you go to that smaller time frame, then do whatever you want for entries. You want another T1 after it hits it, cool. You want to take it directly after it breaks the T1, you just enter right here, stop loss down here, cool, you can do that. If you want to do breakout, cool, you can do that. But this is basically just showing you how you want the market to look. And then however you enter is on you. Everybody has their favorite ways, different ways of entering. That's on you. Now for bears, same thing, right? We're gonna pretend this is the 15-minute right here. And what we would see is where is it at? Okay, cool. So we would want, but when the market come take out this T1, come back down. Again, whenever we get right here, right? This yellow line is the 15-minute. But whenever we get right there, what I personally look for, because 1 minute, right? The 1 minute is going up like this the entire time. Just going up, going up, going up. Whenever we start breaking structure down right there, that's where I look to enter. If you want, once it breaks this right here, let me draw a line so it can be easily seen. Let's get gray or something. Gray was not a smart idea. Let's make that white. Cool. So whenever it breaks that, this is my trade right here. Boom, coming down to this external. Another trader can also just get in at the POI they have right here, stop loss right here. And there's another trader who's going to wait for another T1. And again, there's no problem with that. But this something like this can happen, and you just miss out on the trade. And usually, when you miss out on a trade like that, and you knew where it was going, and you just missed it, that's when you tend to find yourself trying to catch something and doing something outside of your plan, trying to catch a trade mid trade. It's like that just sets up a bad example of what you need to do on a daily basis, consistently. So again, your T1, T2, whenever you find that trap, you want to find it on a higher time frame than you're going to place that trade on. You can also find it on that lower 1 minute time frame, but just know you might miss that trade. T2. So T2 is pretty much we're creating the liquidity. So with T2, we would expect, some type of pullback like this when the markets will start to go up. We don't want it to break it and give us two breaks of structures, but we want to see a three candle formation right here and we want it to start going up. Give us another three candle up here, then eventually take this out. Now the market could always do this if it wants to, right? Like that's never not a possibility, but we're okay with taking the trade like this with the T2 because we have some liquidity. We have a reason to move up from here to external. Now, earlier I mentioned in the rule, it must be present for a full range cycle. So, what I mean by that is, let's say there's not a T1 or T2, but you're playing, let's say the market's coming from, let me draw this. They were coming from up here, right? Boom. And usually, like, okay, my target's up here. This is where I want the market to reach to. If there's not a T1 or T2, what usually happens, the trade that you can take, I personally don't take it often. Let's say you have a key level right here. You can take it to this external, but once you get here, I would exit. The reason I would exit is because the market, let's say it comes here, what we would be expecting based off of just T1, T2 structure is the market to come back down below where you entered at probably to take those people out to then fill the range and go all the way to the top right here. So that's why I say you want to complete a full range cycle, you want T1s or T2s. If you're just looking to go to the nearest external, you don't necessarily need that T1 or T2. But the worst feeling, in my opinion, is for you to be playing this high. Let's say the market wants to do a T2 instead, it gets right here and then it just reverses and takes you out and it goes right back in your favor. I'm sure that's happened to you guys. That's happened to me multiple times. So I personally like waiting for the T1 or T2 to be clear what direction it wants to go. But anyways, T2, yeah, we're basically going up three candle right here. Come up, we don't break it. We might get an equal high or a little bit lower. Three candle right here, come back down. We'll have some type of entry right here. Again, this is on the higher time frame. So let's say that's like the 15-minute time frame. We are going to again come right here. Let's say I go to my 1 minute to find my entry. Boom, on this breakout right here, I'll take it. I'll take that break. And again, you can wait for another T1, but if you do, just know there's a chance of you missing that trade. Then on the bearish end, same thing, T1 or T2. We come up, don't quite come down all the way, find something else to enter off of. Boom. I know some people they say they get confused when they feel like there's a QM on both sides, they don't know which one to do. The one on this side, if you notice, this low was our low. It went up here, came up here, broke this, cool. But from here to here, it never broke any high. All it did was create internal. This is just noise. So T2, understand that it's just noise. Understand three candles aren't going to be broken within T2s. If your three candle is broken on a T1, that's that's different. But with T2, there's no three candle that tends to get broken. So here, you run out liquidity, right? You run out of liquidity. And then the first three candle that's valid. So three candles right here. This is not three candles. This is liquidity because they're all equal lows. So this is not a low that we consider liquidity. This three candle we have, let's see, one, two, three candles, and then the market broke on the fourth candle. So this is valid. Once you break this low, that's the shift, whatever. So that's our break structure. Broke structure here. Then as soon as we broke that, the market came up to here to give us a pullback. So this is now T1. T1 is created right there. And as you can see, the market creates the T1, comes back down. And then you'll see once it came down here, it created the QM on the opposite side right here. So now we know that we can start to look at the buy side. So you, for example, you could take theoretically a trade right here because the market just gave us an opposite QM. So you could play up to this T1 if you wanted to. I don't typically do that because not all T1s get taken, but I mean it's possible. And then once the T1 gets taken out, you see the market dumps. You come to the external, the full end of it. So that's a T1 on the sell side. Again, random liquidity. The reason why this is not the break structure I'm looking at, and this is the break structure I'm looking at, because this is not a three candle that's valid. This is liquidity, it's a whole bunch of equal lows. This three candle is valid because it broke on the fourth candle, not the first, second, and third candle. Let's see if I can find one on the buy side. The market ran this low, so running liquidity there, and then we broke one, two, three, say this high. With this one, for me, if somebody were to say, well, this is the first pullback, one, two, three candle formation, I understand that. The reason why I wouldn't even be looking at this one is because, I mean, it could come to mitigate this last little wick right here. But as far as order flow goes in itself, like this order block has already been mitigated. So I would look at this all as one move, and I consider, or what I would do is just move it all to right here, saying this is my break, full body here, cool. Now, T1, the one I would choose would be here. Now, this is a lot of liquidity, right? But T1 is also liquidity. The difference between this and what I showed earlier is that it's not in a row. Because if you do the three candles in a row, right? One, two, three, there's still one that's obviously lower than the other, meaning this would be cool to be a T1. Now, if it was all back to back candles, three candles in a row, and it was all equal, those are just equal lows. That's not a T1 for me. So this considered a T1, higher time frame, cool. And again, what ends up happening is you can take this two ways. Let's say the POI was right here. Somebody could either take it like this and had their stop loss down here, or had this POI here and then go on the 1 minute and just wait for that breakout. Now let's see if I can find a T2 example. Let's say there's a POI we have right here, right? The market come touch. You'll see that the market dropped, had its breaking structure here. The OS, the run of liquidity right here. Cool. So now we got the start of our range. Market comes up, comes down, or comes up right here. There's a little thing. You see, we get a three candle formation on both of these. Time is also important. Like if it was the right time and we got a breakout right here, I would take it. But I mean, I would never take the trade anyway, just because it's not the right time. But it is above our 50%, which is good. And essentially, you want the market to create internal liquidity. Right now, if it just kept straight down like this, there's no internal liquidity. I mean, you could say right here that this is a three candle formation, there's a T1 here if you wanted to. But at some point, you have to just make a judgment and look at it and say, this looks like one move. Like, even if I go to my line chart, like this is pretty much one move. There's no real pullback or pushback. So some of these are judgment calls, but it's if you look at it, just makes sense of it. Like this is one move. All right. So the market creates liquidity right here, comes and takes out that liquidity, and it gives you a nice drop here. There was a big gap right here, and I'm trying to see if I can see a bullish T2. So the market ran out this three candle. We're just gonna do this high right here. This is all the same. Broke this high, break the structure. It runs up, creates liquidity, comes back down to take out the liquidity. Once it creates all of that, at that point, just remember where your 50% is. Once the market gets to the 50%, find the POI, buy that because the T2 is already there. And then once you have that POI below that 50%, you can find a reason to kind of get in. Make sure that 50% is something that you're looking at. That definitely will help you from unnecessary trades you shouldn't take. I'm not saying you necessarily gonna take a winning trade, but for example, it's easy to sit out on those days when you already feel iffy about it and you're not below 50%. You have more reason saying don't trade rather than trade. So